Hello aspiring traders. Today I'm going to share with you my favorite fair value gap variation, which I have dubbed the R2F gap. From my backtesting and experience, this is the highest probability gap out there. Even without a bias, the hit rate is relatively high. However, of course, you need to have some analysis and rules in place to make it work. There's nothing out there that requires absolutely zero analysis and works 100% of the time. If there was, someone would have found it by now and everyone would be using it. I'll save you some time. Such a thing does not exist and cannot exist. Don't go searching for that. So what is the R2F gap? Very simply, it is a gap with a wick to its immediate left. If we're looking at a busy fair value gap, such as this buy side imbalance, sell side inefficiency, fair value gap, bullish fair value gap, then the previous candle is the one that should have the wick coming out from the top. So in a fair value gap sequence, you have your first candle, which is either consolidation or expansion, second candle, which is always an expansion, and third candle, which again is either a consolidation or expansion. So that's the sequence in a fair value gap. So you're looking for the candle just before the fair value gap itself, 2 or 3 at most candles away. Ideally, it's the candle just before. That's where you get the highest probability R2F gaps happening. So there are a couple of other factors that determine the probability of these gaps. One, majorly, is the higher time frame PD array or liquidity pool have not yet been reached. So if you're looking for a higher time frame inefficiency or a swing high, equal highs, whatever it is, you want to make sure that has not been reached yet. Because at that point, you may be seeing a reversal and your gap would not hold for higher prices. So you decrease your probability if that happens. So some analysis is required in that fact. The strongest gaps have the wick that kind of perfectly fit the lower wick of the third candle, or in a bearish situation, the higher wick. When they perfectly fit like that, those are the highest probability ones. But it's okay if if the wick extends further or even a little bit less, around halfway. But ideally, you want them relatively close to the wick of the third candle. Okay, so other factors that may increase your probability of this gap working is premium and discount. Generally in a range, you want price to come down to a discount before going higher. This increases your probability of your trade panning out, and it's how the algorithm works. It will always come to a discount if it wants to move higher. It'll always go to a premium if it wants to move lower. And the great thing about this R2F gap is that it can be used immediately for an internal to external liquidity model. For example, if the next candle comes into here, internal range liquidity, and then expands out of here, it can be used for that. But not only that, many candles could have formed and higher time frame institutional order flow could have been forming, and that gap again can be used for a potential refined entry on a lower time frame. So as an immediate reaction or as a POI, point of interest for a trade later on, they both work relatively well. So that's it, pretty straightforward. It can work on any time frame. Okay, so whatever the time frame you see the gap on, do your analysis on that time frame and work around that. So I'm going to go to a chart now. I'm going to show you a live chart now, the Solana USDT on the 2-day time frame, and we can analyze some R2F gaps. So every one of these gaps here is an R2F gap. And let's have a closer look. So here's one. You see the 3 candles and you see the wick to the left. Price expands. Eventually it comes down to it perfectly, and then it takes off from there. From here, you see another R2F gap form. Wick to the left, and price comes to it almost exactly, and then takes off. And you see one more form shortly before price expands, comes all the way to it in a sudden drop, and then leaves. From here, no R2F gaps have formed, at least not in this time frame. And the nearest one we see is actually happening right now. So we have a gap. We have a candle body that pierces it a little bit, which is fine. And we have a wick to the left. So is price going to continue up from here? Or is it going to come up into form a gap and then move lower? So you can see we already had a reaction for a 6% move on Solana. Not too bad on the 2-day time frame. So you can watch out for this price action yourself and see if it actually pans out. We have expanded quite a bit into a higher time frame. You call it an area of supply or a higher time frame structure. And now we broke down here. So the question is, are we going to move higher here or not? So the important part is that candles do not close below this area here, or below this order block on the 2-day time frame. So watching the 2-day candles form, even if price comes down again, we do not want to see it close below here, ideally. Okay, it's okay to wick down. It's okay to even wick all the way down here in a sudden crash, as long as it doesn't close below here. Ideally, we do not close even below the midpoint of this R2F gap. So let's have a look at these gaps on a even lower time frame and analyze them a bit. This was the first one where price came into. On this time frame, you'd be quite unexpecting to assume that price is going to react at this exact area. So here we move up, we expand here, and price comes all the way down again, taking out the short-term low. Price expands, comes into this gap and touches the top of the gap. We expand through, up, up. We expand again and look at this sudden drop right to the bottom of this R2F gap. Isn't that quite amazing? Sudden drop doesn't stop it. The manipulation. We continue up, expanding, expanding, expanding. Now we have this order block here on the 2-day. This was the R2F gap. We come into here, sudden expansion down, retrace into the fair value gap here, come back into this order block. So it is possible to come lower. Ideally, if we do come lower, we come here and we leave relatively soon back to the upside. We do not want to keep continuing lower, making fair value gaps on, let's say, the daily or even the 2-day. That would be indicative of possible lower prices. So we'll go back to the 2-day time frame. And yeah, that's it. It's a pretty straightforward gap. Even without a bias, it still has a high probability. Okay, but if you have a bias, that adds that extra benefit. For example, you got price coming into here, expanding up. Now you're expecting it to take out this high here as a point of liquidity. So we expand, come into an internal liquidity, going to an external liquidity. So let's measure this range. It ticks the box of not having reached the higher time frame PD array or liquidity pool. We have a candle on the immediate left, so it ticks that box of not being too far. And that's enough to take a trade, really. The trade could have been taken in this fair value gap here, but eventually it comes all the way down. That's what I've found, especially in crypto. You can find the same things on forex indices. I've used the R2F gaps on those assets as well, but you see them. I find that you see them more often on crypto coins. So it's not something you go around just looking for on every single time frame. If you do see it, great. Do the rest of your analysis and plan out a trade how you normally would. So for reference, let's see what this looks like in a bearish illustration. So in a bearish scenario, it would look like this. We create a R2F gap. Price comes down. It is okay for it to tap into the liquidity pool, but we do not want to see any significant displacement or close below. If it digs too deep and then starts expanding up, I'd be wary about this because liquidity is taken. It may start going for a higher time frame structure. Now, just to reiterate, it doesn't matter what the wick candle color is. It could be green, it could be red. The first candle, the candle before the first candle in the fair value gap sequence, it doesn't matter. So pretty straightforward. Now you have access to a very high probability gap. I hope you found this video insightful. If you'd like me to cover anything else within ICT's concepts, feel free to let me know in the comments or contact me on one of my socials. Till next time, R2F signing out.